Market opens mildly higher on expiry day but gives up gains. Global cues remain positive as US federal court strikes down Trump's reciprocal tariffs. The Nifty trades higher, led by metals and the IT sector. The broader markets in line with key indices.
Deepak Nitride rallies after a better-than-expected fourth quarter. The margins expand 150 basis points, while the Phenolics business drives revenue growth.
Max Financial Services revenues decline almost 2%, or rather the company's stock declines 2% after Axis Max Life Insurance MD and CEO Prashant Tripathi announces early retirement effective from the 30th of September.
Cummins India trades with solid gains on the back of its fourth quarter numbers. The revenue grows by close to 6% on a year-on-year basis. The company has also met its double-digit growth guidance for FY25. The con call is underway and the commentary is fairly optimistic.
Mishra Dhatu Nigam rises over 4% on steady fourth quarter numbers. The company's net profit jumps 21% year-on-year. Margins too expand 300 basis points.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. It's expiry day, and as we speak, though, Mangalam, the market's still trading with some green, though we've come off the high point of the day.
Yes, Nigel, it opened higher. The street expected there would be some supply because that's the zone from where we had seen some retreat, markets retreating earlier as well. That's exactly what took place. The question is whether we see a bounce from here or not. And if we do, then there could be a pop towards the last hour of trade, largely because of the shots that are there in the system for the market and the fact that there is May series settlement that takes place today. It's the Nifty Bank that has to move higher for the overall markets to move up as well. But we're talking about all things global economics. Erin Capiten, who is the chief economist at UBS Investment Bank, joins us from the sidelines of the UBS Asian Investment Conference. Thanks a lot for joining in, Erin. It was a pleasure speaking with you. We're speaking about the global economic outlook, and I look at your forecasts as well. I just wanted to understand what proportion of your growth estimates are contingent upon US-China or the global tariff uncertainty, because there's so much back and forth out here. What weightage have you accorded to these in your model? And how much of this is agnostic of what transpires in global trade?
Yeah, the short answer is all of it's conditional on what happens on the tariffs, to be honest. So now, related to tariffs, there's other things like, uncertainty. You could argue that not all of the uncertainty is related to the tariffs, but it's really all about the tariffs. So had we not put the tariffs into our forecasts, we wouldn't be forecasting global growth at 2.7. We'd probably be much closer to the levels that we had last year, which were a little bit above 3.
So the reason why I ask you this is because, it is so back and forth. There is a certain number today, there is a certain number tomorrow, and then day after tomorrow, chances are that there is no number. How does one then account for all of these?
Yeah, no, exactly. So we've adopted the approach that we will mark to market whatever tariffs are in place. We're filming this on the 29th, and we just had this court ruling that basically has vacated all the tariffs.
Exactly.
It doesn't vacate, of course, some of the sectoral investigations. So the auto and steel tariffs, those are still there, but we'll now have to see what happens. There's 10 days to appeal the court ruling, so we'll have to see whether these tariffs actually get removed or not. My guess is that even if they do get removed, then the administration will find another legal authority to try to put them back in place. But where we stand today is that the U.S. has imposed roughly 1.5% of GDP worth of tariffs. Back at the peak before the China de-escalation, it was about 2.5% of GDP. But as you say, it keeps moving around, right? This threat against the EU, that's another 0.5% of GDP. So we just keep changing our numbers. And I think today's good news, right? So there's the hope now that maybe these numbers come down, but I think we'll wait to see the appeals ruling before we change our numbers.
We've heard of economists, we've heard of hedge fund traders mark to market, we've heard of long-term investors not mark to market, but here we have economists marking to market as well. That's the world that we're in, Nigel.
Well, that's right. Hi, Erin. Good to see you on the show, and thanks a lot for joining in. This is Nigel on this side. The world was focusing on MAGA, that's Make America Great Again, and suddenly this morning we're waking up to TACO. That is Trump, again, chickened out. He says no, but let's hope there's some rationality that does play out, and in fact, it'll be a better place, in the global front as well. But Arvind, from an India market perspective, we have plenty going for us, right? We have crude oil prices that are lower. We have a rupee that's fairly stable, good leadership as well. The problem for us is the globe, because the globe is in a tizzy and plenty of uncertainty, with central banks as well being fairly uncertain of being fairly flimsical. What are you assuming with regard to the India growth story? And do you think there are enough tailwinds for us to continue to growing?
So India is in a relatively better place just because it's more closed than most economies, right? So I think in Asia, the countries that are sort of relatively immune to all this tariff uncertainty and the drag from global trade are India, Indonesia, really the large sort of more closed economies. But there's also a silver lining, I think, for India. Like if these tariffs were to actually be implemented, and particularly if the tariffs on China are very high, then India is potentially one of the big beneficiaries. Now, that's more, I think, medium term as the Chinese trade surplus gets redistributed across the region. In the near term, I think what's playing out is just sort of a very disinflationary dynamic. So everyone's growth is a little bit lower, right? So we're feeling the pain of the reduction in trade, the lower growth in China, Europe, the US, right? So that hurts everyone. But there's also a disinflationary impulse because outside of the US, these tariffs really are not inflationary if you don't respond to them. If you don't raise tariffs, it's not inflationary. And so that's opening the door for significantly more rate cuts. And so one of the places where we think there is basically scope to cut more is India.
Right. In your report, you've written that as long as orders don't turn around, it is unlikely that we see a turn in global trade and production, which have been depressed for the last 2 years. And at the same time, you've written that there is no stimulus coming in from any government in the world apart from China, which is about 2% of their GDP. What, according to you, will drive global growth from here on? And what should really happen? Because even the labor force participation is now back normalized.
Yeah, so I mean that's on the fiscal stimulus. So I do think we get globally some monetary stimulus, but you're right. So fiscally, I think there's not a whole lot that is moving, and so so we do. We think in the next sort of 4 quarters we do have a slowdown. It's very difficult to offset that if no one is actually providing any kind of fiscal stimulus, but it's very much a slowdown concentrated in the net export sector. So if you look at the domestic demand dynamics, they are generally a lot healthier than I think the export dynamics, and so that part of the economy is generally a little bit more shielded. But it'll take until the middle of next year before we sort of start to climb out of this uncertainty and this tariff shock. So we call that a deadweight loss. It's basically a level shift lower in the global economy, and then eventually we'll go back to the old growth trajectory.
All right, Arvind, what about this U.S. deficit and the debt? That's clearly worrying, right? What kind of numbers are you assuming? And could the administration, the United States, find some kind of a way out? Because you have yields that are spiking, which is clearly a sign of caution.
Yeah, so we're on a clearly unsustainable trajectory. We even with the bill that's now come out of the House, we're looking at a deficit that's still going to be in excess of 6% of GDP. That's including the tariff revenue. If it's excluding tariffs, then it's about 6.5. That means the debt's going up by 3 percentage points of GDP per year. That is faster than any other country that we have under our coverage. But it still means that it's going to take another 10 years before the US overtakes Italy, which is trading at a lower yield, right? So yes, we're on an unsustainable trajectory. It's not yet clear that automatically then should translate into a significant repricing of the debt. Now, the fact that that's happening is partly because it's getting mixed in with, I think, all the other reasons people want to be reducing their US positions, which is the policy uncertainty, some of the erratic decisions that are being made. I think that global investors came into the year with too much US exposure. And so that unwind is sort of getting mixed in, I think, a little bit with the long-term sort of debt sustainability concerns. The one thing I'd say is because there's sort of a common narrative that the backup in long-end yields that we've seen in the US is related to this rotation of foreign investors away from the US in the last couple of weeks. That is actually not the case. And the US Treasury puts out numbers every few weeks about what is the foreign demand for their debt. And the interesting thing is that it's not the foreign demand that's fallen off, it's to some extent the domestic demand that's fallen off.
That's an interesting point that you make out there. So foreign demand for US debt is still fairly steady. Then, the simple question and perhaps a not so simple answer to this would be, what happens? What has to happen for, all of this to turn around and for us to come up? Because from where we see right now, there is a fair amount of fog on the windscreen.
Yeah, so I think that's one of the things we struggle with, right? So even if you remove all the tariffs, the question is, have you removed all the uncertainties? So if you look at, for instance, US and Eurozone uncertainty indices, then they're about 4 standard deviations above a long run average. Now that is so far above normal that, and if you run, we call this impulse response functions. If you basically try to estimate how much that is worth in terms of the growth drag, that is more than the entire forecast revision that all the banks have made for the global economy. So it's very, very significant. So if you're a corporate and these tariffs are now removed, the question is then, how certain are you that the US administration is not going to try to reimpose those tariffs? Is it really the case that you can now place 100% of the order that you had been delaying? And so I think there's some lasting damage here based on what's happened the last sort of 3-4 months, even if the tariffs now get taken down by this court ruling.
All right, Arvind, we've been hearing Mr. Trump talk about drill, baby, drill. I'm wondering whether he's going to start pushing for print, baby, print. What are you factoring in with regard to the Fed action from here on? Could they go ahead and cut rate cuts? Because even the last year, we were factoring in far number of rate cuts, but by the end of the year, they were much lower. And for this year now, there is some question mark on whether or not you're even going to get a couple of rate cuts. What are you factoring in?
Yeah, so I mean, fortunately, he doesn't control the Fed, right? So,
yeah, that's good.
And the court ruling we had, I think, last week was very significant, right? So the Fed's independence seemed to be explicitly sort of mentioned as being separate from some of these other regulatory agencies. But so we think, our view is that the Fed is going to, if these tariffs do go ahead and you get unemployment starting to increase, then even if there's inflation, their reaction function will be to try to ease into that. And the reason is that the level of the Fed funds rates is still in restrictive territory. So they will basically want to get to something that is much closer to neutral. So we have about 100 basis points in cuts penned in for the second half of the year. But that is really conditional on seeing the labor market start to weaken. We haven't seen that yet. And so if we do not see labor markets weakening and we do see some of the inflation pressure come through, then I think they're stuck and they probably stay where they are. But I think their inherent bias here is to want to get to slightly less restrictive territory if you have tariffs that are basically doing all the slowing of the economy for you.
Right. Final question before we let you go around. I think the crux of your report, one of the most interesting things was the vacancy to unemployment ratio. What does that tell you about where we're likely to go from here?
So vacancy to unemployment ratios are coming down all over the world, and they've actually been coming down pretty rapidly in the US, but they're more or less back at 2019 levels. So, and those were still very, very tight labor markets. So the starting point is actually quite healthy, I think, going into this sort of potential growth shock or this tariff shock. So labor markets are tight. I think that's holding up demand. But from these levels, I think we are going to see that vacancy to unemployment continue to go down. If you remove demand and everyone is growing below potential growth, then we're going to start to see unemployment creep up. And that's basically in the forecast for the next sort of 6 months to 12 months.
And if you had to, deploy $100 in a portfolio for the next 6 to 12 months, how would you distribute that across asset classes and geographies?
So right now I would be, if it were me personally, I would be, you can go back to what happened in 2018 and 19. In 2018, the best performing asset was actually just to stay in the sideline and be in cash or in gold and stay away from the risk assets. And then in 2019, you had to do the reverse, right? And so there's basically an issue here of when is all the bad news priced? And until that happens and you have clarity about where the tariffs settle, you want to be incredibly defensive. And for us, that means being effectively trying to be long fixed income, maybe not in the US, but certainly as we have about a basket of emerging markets, some of the European countries, you try to sort of stay a little bit in the assets that sort of benefit from lower growth. So that's fixed income, golds. Stay away from equity effects. But then as we sort of price the news and we start to get some easing, then you rotate back into some of the risk assets, which will be equity. Credit, I think, is too early, hasn't really repriced yet. And then geographically, I think right now you largely want to stay away a little bit from the US. So we're sort of neutral US and we're basically overweight some of the European countries and some very select emerging markets. But in general, I think it's a bit too early to be long equity here, even with today's headlines.
Incredible. Thank you so much, Ren, for joining in. Wish you a good conference and maybe a lot of insights emerge from that as well, and perhaps some clarity over the next couple of weeks as well. Take a short break, come back. We focus on the micros, the stock-specific action with Sachidanand Uttekar of Trade Bulls. Virtually unchanged for the market right now, so good time to get in a quick view on where we're likely to go from here. Sachidanand Uttekar of Trade Bulls joins in now. Sachi, the Nifty has petered out all the gains that we saw at the open. Right now, absolutely flat. What would your trade on the indices and individual stocks be quickly?
Good morning, Mangalam. Mangalam, clearly, I think the view on the market remains sideways. Even yesterday, for the last two trading sessions, we have been maintaining this particular view that it is ideal to, build some long positions on a decline, but the support is placed somewhere close to around 24,630, where its 5-day exponential moving average is placed. And on the higher side, we need a decisive close above that 24,830 to unlock that move towards 25,000. So overall, the structure is bullish, but we are locked into a range-bound, mode. And probably, one should wait for the decline to deploy some long positions. The best position, the best level would be close to that 5-day exponential moving average, which is placed at 24,630, or on a breakout about 24,830 itself. So when we look at Nifty Bank, it's a very similar, data set. 55,000 remains as a very strong support, but on the higher side, we need a closing above 55,540. After that, we may see some directional up move. So as of now, for the day, I think it's better to wait and wait for the decline to extend. And probably 24,630 would be an ideal level wherein some contra longs on the Nifty can be deployed.
Okay, all right. Hi, Sachi. What about individual stocks? What are you looking at?
Nigel, I'm liking MGL. The stock has maintained a strong range throughout this particular series. We have seen good support at around 1300, 1320 levels. It has again displayed a good rebound. We are expecting that this particular rally may continue towards 1440, and eventually we may see an extended move towards 1475 in the coming series. And that's why we are recommending building long positions in MGL, keeping a stop loss at 1370. And intraday, a positional target would be placed at around 1440. The second stock on our radar is Trent Limited. Again, here, if you look at the overall structure, the stock is challenging its 200-day exponential moving average. What we expect is that there could be a breakout soon in this particular counter, looking at the way the trend state indicators are placed. So we are expecting a rally towards 5830, and that's why we are recommending building long positions with a stop loss at 5560.
All right, Sachi, thanks a lot for that. Let's get you some ideas for profit coming in from our colleagues at Money Control Pro now. We have Varsha Bang, who's joining in with a stock that she's been tracking. Varsha.
Bazaar Style, an emerging player in India's value fashion retail segment, operates under the Style Bazaar brand and has expanded rapidly since its inception 2013. With 2014 stores across 170 cities, the company focuses on Tier 2, 3 and 4 markets, especially in East India, benefiting from a cluster-based expansion model that enhances operational efficiency and market penetration. A key growth driver is its private label offerings such as Square Up and Avia, which contributed 44% of revenue, expected to increase 60% by FY27, enhancing margins and profitability. In FY25, Bazaar Style recorded a strong 12.8% same-store sales growth, driven by increasing footfalls and larger basket size. The company's family-centric approach and localized merchandising have fostered strong customer loyalty with 73% repeat customer rate. Looking ahead, Bazaar Style is strategically positioned to tap into the rapid growth of India's value fashion market, particularly in the under-penetrated regions. With plans to open 40-50 new stores and expected revenue growth of 20 to 25% annually over FY26-27, it represents an attractive investment opportunity.
Thanks a lot for that, Varsha. Well, time to slip into a short break. As we do that, we are excited to unveil a brand new global business news channel, the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on India businesses, giving you unparalleled insights. Tune in to CNBC-TV18 Prime at 12 noon for the global reset and the global lens at 8:30 p.m. Welcome back. Markets as flat as can be, but let's tell you about a few stocks that are moving around in today's trading session. Avanti Feeds, that's surging after reporting a solid set of numbers. Ria joins us to decode that set. Ria?
Well, good morning. Let's take a look at how the numbers have panned out for Avanti Feeds in this quarter. For quarter 4, they've seen good growth in the overall revenue, up around 8% over the previous year. Very strong improvement on the profitability front as well. For quarter 4, EBITDA and net profit have jumped up by around 26% and 39% respectively. Even on a full year basis, EBITDA and net profit are up around 38% and 51% respectively on a year-on-year basis. Quarter 4 EBITDA margins have also seen a jump of around 267 basis points, with the full year margins going up by around 200 basis points compared to the previous year. Coming to the segments of the company, for the shrimp feed revenues for FY25, remember this constitutes around 78% of the total revenues. For this segment, the revenues have increased marginally, just about 3% over the previous year, but the EBIT margins have seen a very sharp jump up of around 500 basis points compared to the previous year. For the processed shrimp segment, though, this contributes around 21% of the total revenue. For this segment, the revenues have gone up by around 9%, but on the margin front, we've seen a very sharp decline of around 500 basis points over the previous year. And remember, the margins have been under pressure over the last year because of increased freight costs, higher raw material costs as well, and even the higher countervailing duties imposed by the US have caused some margin pressure for this segment. So this is one segment where the company has underperformed, but largely the results look very strong for Avanti Feeds, which is why the stock is trading higher today.
Take that point, Ria. Thanks a lot for that. Meanwhile, just watch out for Cummins. That stock is now surging up around 6%. The conference call is currently underway. We are, getting some positive commentary coming in. They said that they will continue their capex in the same range as FY25. But more importantly, what they're expecting to see is maintain their gross margins for FY26 and look at some growth as well for the next year. What we'll do is we'll at some point get in Vamakshi to give us a roundup of all the key takeaways from the conference call. Currently, the street likes what the management is saying. The other one is Deepak Nitrite on the back of good numbers. Remember, their conference call starts at around 12 today, so we'll have our team listening into that as well. And finally, we have Strides Pharma, which too has surged to the high point of trade. So even as the frontline indices are consolidating, a lot of individual stocks clocking in big gains. Take a short break, come back. On the other side, we have the team of Trading Hour taking the next hour of trade forward.